if you are brand new to planning for taxes and retirement, you're going to learn a lot today. Okay, it might be too much, so you might have to come back and take some notes or rewatch this again. But what I wanted to do today was to really give you a wonderful overview of all the things you should be thinking about when it comes to taxes in retirement and all the ways to possibly plan. Obviously, I can't go into every single strategy that's available, but what I am going to do is give you a framework and give you some specific exercises or steps that you can take, and also questions that you can ask your tax professional or financial professional if you're working with one to help you out. And if you don't have anybody and you need somebody to help you out, then please visit our website, keepitsimplefinancial.com. I would love to speak with you and see if we're going to match work together. So we're going to jump right in. We're going to first start with some background around tax planning in retirement and all the things you need to think of. And we're going to start with some education, okay? Because I want to get everybody calibrated and on the same page around the education part. And there may be some repeats of things you heard here before, okay? But there's also going to be people that have never been to any of these workshops. They know nothing about taxes in retirement. And so we want to make sure that we're helping those folks out as well. When it comes to your tax planning, these are things that I can control, and this is real tangible value that if you get someone that's good at tax planning to work with you, you can put actual dollars, and as I mentioned in my post here, we can rescue them from the grip of the IRS, okay? So if I know anybody here, and if I know you all here, I know that you definitely want to save money on taxes in retirement. So let's jump right in and talk about that today. I do have to let you know that this is for informational purposes. This should not be used as specific tax, financial, or investment advice, okay? So I have to just let you know that. But who is this for? Okay, so this is for anyone who is a good saver and you're close to retirement and maybe you're feeling overwhelmed or you just want more clarity on your finances and specifically with taxes. So if you have saved a good nest egg in pre-tax retirement accounts like 401ks and traditional IRAs, then this is definitely for you. All right, so in this workshop, here's what we're going to cover. We're going to cover the top 6 things you should focus on with your tax planning and retirement, the 10 key questions to review with your taxes and or your tax advisor, and then we're going to cover a case study to see what these principles look like in action. And my promise to you is by the end of this, you will walk away with tangible tax planning ideas that you can implement starting today, okay? That's my promise to you today. For those of you that don't know me, let me introduce myself very quickly here. My name is Jason J. Hamilton. I'm a certified financial planner and a chartered retirement planning counselor, the founder of Keep It Simple Financial Planning, which we are a award-winning registered investment advisor. We're a fee-only firm, so we do advice for a fee, and we also do asset management for a fee. And we've been voted, I've got quite a few awards the last couple of years, but most client-focused retirement planning firm, top 10 wealth management service, among others. And we specialize in clients that want help saving on taxes, optimizing their investments, and getting to alignment with their financial freedom, okay? So I know so many people come towards retirement completely stressed out about all the things they need to do, and especially like if you're ready for retirement, do you have enough? And then if you do find out you have enough, then it's like, well, okay, what about taxes? What do I do with my 401k? What do I do with my investments? Those are all the things we can help you with, okay? So let me ask you, does this sound like you? Okay, so you know the government is planning to raise taxes. Maybe you are like me. I'm looking at this national debt we're dealing with here, and I'm looking at the policies that are coming out of Washington. And to me, it looks like taxes are going to be going up. Do I know that for sure? No, I don't, by the way. But it does look like taxes are going to be going up. And taxes are actually like one of the historic amount of lows they've ever been. So it's likely that they're going to go up. So that's my belief. So if you're somebody who believes that, then you're in the right place. You have a large pre-tax retirement account and you're just not sure how to manage it in retirement. You think you may have more saved than you need, but you're not sure what to do to properly retire, so you do nothing, okay? So if you're somebody who gets into analysis paralysis, then maybe you're in the right place here. You know, your financial advisor may help you with investments, but never brings up tax planning for retirement. Okay, so full disclosure and disclaimer. I've had a couple people in the last couple of weeks tell me their financial advisors were upset with them because they started asking them questions that I said to ask, okay? You know, it is what it is. The old world where your financial advisor only does investments, I think is outdated. And by the way, If all your financial advisor does with you is investments, then you might want to start searching for somebody else that can help you with retirement and tax planning, timing your pension, Social Security, and annuities, whatever may else be coming in, because these are highly valuable strategies that if you understand how to integrate your financial planning, it's going to be a lot more money for you at the end of the day. Maybe you don't have a financial advisor yet, but you're not sure what to ask when interviewing them. I'm going to give you some great questions to ask about today. The final point here, you just really want to keep the IRS's grubby hands off of your hard-earned savings and you aren't sure where to start. Okay, so if any of these sound like you, then you are in the right place today. All right, so the big question I have for you today is, do you feel like there's just so much information you need to know and you just don't know where to start? If that is you, then you are 100% in the right place. And the great news is there are really only 6 main things you need to know for effective tax planning. And if you get these right, you'll be doing better than 90% of all the other investors out there, okay? So here are the 6 key focuses that you need to have for tax planning in retirement. So the first one is tax efficient investing, okay? You wanna make sure you're invested efficiently. The second one is asset location strategy. And by the way, I'm gonna go into these in depth, but I'm gonna cover them really quickly here. The third one is tax loss trading and capital gain harvesting, distribution planning and Roth conversions, charitable giving, and then we need to look at the tax gotchas, like Medicare IRMA surcharges, net investment income tax, also known as NIT, and the widow's penalty. Okay, so some of you will never have to deal with the first two, like IRMA surcharges, because your income's not gonna be high enough, or net investment income tax. But if you're somebody who's married and you have a spouse, there's something called the widow penalty that definitely I think most people are gonna have to deal with, because it has to do if one spouse passes before the other, okay? So let's just take these one by one. I'm going to break them down, like I said, and help you understand what they are so that you know what I'm talking about today. So the first one here is tax efficient investing. So let's take a look at investing in relation to retirement accounts, ETFs, stocks, bonds, mutual funds, annuities, and real estate. Let's start with retirement accounts. Retirement accounts like 401ks and IRAs are specifically designed for saving for retirement. They offer tax advantages, which can help you save more money over time. These are very powerful accounts, so I do not want to turn you away from them. It's just a matter of in retirement, you're gonna have to deal with the taxation. So in a traditional 401k or IRA, your contributions are made with pre-tax dollars, which means you don't pay tax on that money until you withdraw it during retirement. This allows your investments to grow tax deferred. So this feels great when you're in your working career because your tax bill goes down by contributing. And then you get to retirement and you have to take the money out, and then you have a tax bill, and then it gets annoying. But hey, at least for the first 30 years or so of you working, you didn't have to, you felt good, but now you have to deal with it, and that's a little bit more on the not so fun side. The other types of accounts are called Roth 401ks or Roth IRAs, and these use after-tax dollars for contributions, but your investments grow tax-free after you contribute to the account. So you won't pay taxes when you withdraw with them during retirement. So there's benefits to each of these types of accounts. And the key is understanding how to utilize them in the best way for you and your individual situation. When I say pre-tax accounts like 401ks, I'm also referring to 403bs, TSPs, 457s. There's a lot of different types of accounts, simple IRAs that you can use through your workplace plan. That is in relation to all those, but I just didn't want to list them all out here today. Okay. The next thing is stocks, right? So simple stocks, individual stocks, they can actually be very tax efficient if you manage them properly. Tax efficiency is different than complexity though when it comes to your investments. I'm not a big fan of single stock investing, but hey, we're talking about tax efficiency today, so I'm going to talk about this. So by holding your stocks for at least 1 year, you can benefit from lower long-term capital gains rates when you sell them. And this is if they are not inside of a retirement account like a Roth IRA or a traditional IRA. Additionally, the qualified dividends from stocks are taxed at a lower rate than your ordinary income, generally 15%, but it might be as low as 0% or as high as 20% depending how much your income is in that particular year. But those are individual stocks. Then we have bonds. There are mainly 2 types of bonds. You got corporate and government, pretty straightforward. While corporate bonds are subject to federal income tax, some government bonds like municipal bonds are tax exempt or taxed at lower rates. Government bonds called I-bonds have been all the rage in the last couple of years. Those are beautiful because you're gonna get some of that money tax-free. Municipal bonds are issued by state or local governments and can provide tax-free income, making them an attractive option for tax-efficient investing. If you want to have some bonds or bond funds outside of your retirement account, municipal bonds could be a good choice for you because you might be able to save on some of the taxes. Whereas Corporate bonds, you generally do not want to have those outside of a retirement account because they're not very efficient. So keeping those inside of an account like a traditional IRA, traditional 401k, can be a good place to keep things like your normal corporate bond funds. All right, mutual funds. Mutual funds are investment funds that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. You can also invest in real estate, potentially through real estate investment trust. Some mutual funds, like index funds or tax-managed funds, are designed to be tax efficient. Index funds track a specific market index and generally have a low turnover rate, which can reduce taxable events. So many people lately have actually asked me, like, what the heck is the difference between an index fund and a mutual fund? Like it says here, an index fund is just a mutual fund that tracks an index. So for example, the S&P 500 is an index. So you can get an index fund that has S&P 500. Does that mean that's all you need is one fund? No, you're going to be leaving out, I think, 12 or 13,000 other companies potentially. I think maybe 11,000 other companies if you only invest in the S&P 500. So you want to make sure you have more than just one index, but index funds are a great way to invest because they're very low cost. Tax managed funds aim to manage the taxes by using strategies like avoiding short-term capital gains or investing in tax-exempt bonds. So mutual funds are great. Generally, they're better for inside of retirement accounts or versus outside of retirement accounts. And so mutual funds can be actively managed as well. But what we found and what the data tells us is that over long periods of times, pretty much 90% of mutual funds are not going to outperform the index. So you could do a lot worse than just holding some index funds and calling it a day. It makes your life very simple. But if you're somebody who doesn't want to just take the passive returns of an index fund, there are many actively managed mutual funds, and you want to make sure you're considering things like their prior track record, also the cost of the fund, and you want to look at something that how long that fund's been around. Because there are some gotchas with mutual funds where funds absorb other funds that underperform. And so you really want to be careful with that. So this is where if you get an index fund, it makes things very simple. And it's one easy way for you to start investing on your own. All right, exchange traded funds. These are like the upgraded version of a mutual fund, essentially. So very similar, but these are investment funds that hold a collection of stocks, bonds, or other assets and are traded on a stock exchange like individual stocks, okay? So the difference between ETFs and mutual funds, there's some tax efficiency differences where generally ETFs are more tax efficient. But another big one is how they're traded, where mutual funds generally trade and settle at the end of the day, where ETFs you can trade throughout the day like you could trade a stock. So again, these are pluses and minuses to both, but if you're a long-term investor and you want to have lower costs, generally, not always, but generally you're going to find lower costs in an ETF version of a fund versus a mutual fund version of a fund. So ETFs can be more tax efficient than mutual funds because they usually have lower turnover rates as well. So what that means is the investments within the fund aren't bought and sold as frequently, which can result in fewer taxable events. Additionally, the structure of ETFs allows them to minimize capital gains when assets are bought and sold within the fund. So Vanguard has some ETFs that have a patented trading process where they were keeping taxes very, very low. On the other hand, Vanguard has what are called target date funds or a target date mutual fund. And those funds had, there were some big problems with them a couple years ago where people that held those outside of tax deferred accounts, like their 401k, for example, they had a big taxable event and Vanguard had a big lawsuit, okay? So this is where, when I talk about asset location, I'm gonna get to that, but it's super important to where you hold different types of assets, okay, and different types of accounts. All right, then we have annuities. So annuities are insurance products that provide a steady stream of income during retirement. And there are two types of annuities, basically, fixed and variable, okay? And both can offer tax advantages. Tax deferral is one of the big ones. So the earnings on annuity investments grow tax deferred until you start receiving payments, which can be an effective way to accumulate wealth over time. When you withdraw from the funds from your annuity, the earnings are taxed as ordinary income. So that's a downside. There's something called an exclusion ratio. So for non-qualified annuities, those purchased with after-tax dollars, that would be outside of a retirement account, a portion of each annuity payment is considered a return of principal and is not subject to taxes. So the exclusion ratio is used to determine the taxable and non-taxable portions of each annuity payment. Another benefit of annuities are there's no contribution limits. So unlike other tax advantage accounts like 401ks or IRAs, there are no annual contribution limits for non-qualified annuities. This allows you to invest more money in a tax-deferred account if you maxed out contributions and other retirement plans. So I see many times when I'm speaking with investors that they get sold annuities, non-qualified annuities, before they've even maxed out their retirement accounts. I'm not anti-annuity. I'm just more so do other things first and then go to annuities when you need them for specific purposes. And so, for example, if you have not maxed out your 401k, well, then you may not need an annuity. You might want a steady stream of income in retirement if you don't have a pension, for example. So then you might want an annuity, and then you can trade some of your money that you have saved in an account somewhere to purchase an annuity that gives you a guaranteed income stream. Could be good for that. So again, there's pluses and minuses to everything. It's all about how you use the products. All right, real estate. Real estate can be a very attractive tax-efficient investment for retirement, offering various tax advantages. One, you get the mortgage interest deduction. Okay, this is not as good as it used to be, but it's still good. Mortgage interest paid on a primary or secondary residence can be tax deductible, thus reducing your taxable income. Depreciation, this is a big one, okay? The IRS allows you to depreciate the value of a rental property over a set period, which is 27.5 years for residential property and 39 years for commercial property. This annual depreciation expense can offset rental income and reduce your taxable income. Very, very powerful over time. 1031 exchanges. So this provision allows you to defer capital gains on the sale of an investment property by reinvesting the proceeds into a similar like-kind property. By doing so, you can defer paying capital gains until you sell the replacement property. So potentially, if you are a real estate investor and you have rental properties, you can sell one rental property that's gone up in value and then do a 1031 exchange and purchase another property and technically not pay taxes. There's a potential to not pay taxes ever on some of these properties, for your whole life. This is the power of real estate. But again, real estate has its own hassles, where the markets, you just have the money in your account. You can manage that from your computer. You're not dealing with having to deal with landlords or property managers or renters. So again, I always tell my clients that if you want to be a landlord in retirement, you're technically not fully retired. You have a part-time job. So if you are in quote-unquote retirement, leave your job, and you have a few rental properties, even though you have a good property manager, and I'm sure you do, you're still gonna have to deal with something over time. The capital gains rates. So if you hold a property for more than a year, the profits from the sale are considered long-term capital gains, which are taxed at a lower rate than ordinary income. This is for a rental property. For your primary property, the one you live in, if you live there the last 2 out of 5 years, you can get a capital gains exclusion up to $250,000 if you're a single tax filer, or up to $500,000 for joint tax filers. So that can be a tax-free gain on properties if you decide to move. Okay, you have to live there 2 out of 5 years. Asset location strategy, also called tax-efficient funnels. Okay, we're going to talk about this, and this is something that you should be talking to your financial advisor about if you don't have one. Because this is a super powerful way to really keep your taxes lower, have better gains in tax-free accounts or more tax advantage accounts. And so this is something that you really want to make sure you have a good plan for as you're going into retirement. So asset location strategy is about placing your different types of investments in the most suitable account types, like brokerage accounts or retirement accounts or tax advantage accounts, to maximize tax efficiency and overall returns. So it's like organizing your belongings in a room, right? You're going to put the right things in the right places to make the best use of the space and keep everything neat and tidy. So to better understand asset location strategy, let's look at the common account types and how they relate to different investments. All right, so taxable brokerage accounts. You generally have 3 types of accounts: taxable, tax-deferred, and tax-free. So we're going to start with taxable brokerage accounts. So these accounts are funded with after-tax dollars, and any interest, dividends, or capital gains you earn are subject to taxes in the year they are received. The strategy here is to hold tax-efficient investments like stocks that pay qualified dividends, or tax-efficient ETFs, which generate fewer taxable events and are subject to lower tax rates. So remember I told you, target date funds are generally mutual funds, okay? So Vanguard, again, Google Vanguard target date fund lawsuit. Google that and read that story, because you'll see what I'm talking about. There's a massive taxable event because they rebalanced it, and generally most funds, especially like index funds, they recalibrate the funds on the same date every single year. It's very predictable. So that's one efficiency of using index funds versus a more active fund. But that's going to happen all at once, regardless of what's going on generally. It's not going to be timed, and this is where having managed funds or managed ETFs can be more efficient. Tax-deferred retirement accounts. So as we spoke about, traditional IRAs or 401ks. These accounts allow you to contribute pre-tax dollars and your investments grow tax deferred, meaning you don't pay taxes until you withdraw the money in retirement. So in these accounts, it's wise to hold investments that generate higher taxable income. Like I mentioned, your bonds, REITs, so real estate investment trusts, or actively managed mutual funds. This way, you can defer taxes on the income generated by these investments until retirement when you might be in a lower tax bracket. And most people are in a lower tax bracket, by the way, in retirement. So tax deferred is usually a pretty good way to save prior to retirement. And you want to have some in brokerage accounts and ideally some in tax-free accounts too. But this is where we talk about tax diversification. All right, now we have tax-free retirement accounts. So here we're going to talk about Roth IRAs and Roth 401ks. These accounts are funded with after-tax dollars, but your investments grow tax-free and you don't pay taxes when you withdraw the money during retirement. So in these accounts, you might want to place investments with high growth potential, like stocks or aggressive growth funds to take advantage of the tax-free growth and withdrawals. Those are our 3 account types. Tax efficient funnels, okay? So these types of accounts here are considered taxable. These contributions are made with after-tax dollars. So brokerage accounts, bank accounts, and real estate. And so as you see here, so think about this like a funnel, okay? So the money goes in at the top, contributions are made with after-tax dollars, goes through your funnel here. And then when it comes out, the growth from the account may be taxable, okay? That's how taxable accounts work. Tax-deferred accounts, okay? Tax-deferred accounts, the contributions are made with pre-tax dollars, okay? So they're gonna go into the funnel pre-tax, that's your 401k or 403bs, your IRAs, and your pensions. Then when they come out, they're distributed and taxed as income, okay? So that's gonna be taxed at your full tax rate. So generally, if you're in a higher tax bracket now than you expect to be in retirement, tax-deferred accounts are great. If you're in a lower tax bracket now than you're gonna be in retirement, well then you wanna move over here to our friend, the tax-free accounts. So tax-free accounts can be made with pre or after tax dollars. So with the tax-free accounts, we could be looking at Roth IRAs, Roth 401ks, FSAs, HSAs, 529s, or cash value life insurance. So all of these can be part of our tax-free account strategy, okay? So all of these accounts have their own benefits. They have different things that may come into play. And, you really just want to do what makes the most sense for you, to be honest. I mean, everyone's going to have a different philosophy on the way they believe they should be investing for tax efficiency. But this is where you really want to work with a financial advisor to make sure that you are doing the best things that you can for yourself and make sure you're looking at the big picture, not just making decisions only on saving taxes today, because it's important to save taxes today, but it's also good to save taxes in the future. And if you have a plan that encompasses all, both sides of that coin, you're going to be happier, okay? And trust me, I deal with a lot of people that are not very happy because they have to pay so many taxes in retirement, and with a little bit of planning, they might have been better off. In the center, you're going to see this big wrecking ball of government tax policy, okay? So the way I look at it is, you want to look at your contribution decisions on a year-to-year basis and make sure that you are considering tax policy when it comes to the way you're investing for retirement. So if government tax policy is bad, then you might want to just go to your tax deferred accounts only. That could be something that works best for you. If government tax policy is good, like taxes are lower, then you might want to go to the tax-free accounts and maximize those because those might be the best for you. So, all these things, like I said, everything's going to have a plus or minus, because if taxes go up later in retirement, well, then you're going to wish you paid taxes earlier on in your Roth accounts. And the opposite could be true as well. So, these are all things that at the end of the day, part of it's a guess. We're going to do our best to guess and make sure that we're doing, whatever we can do. But, things have generally been relatively predictable that most people are going to be in a lower tax bracket after retirement. So again, something to think about. So asset location strategy. The asset location strategy aims to balance the tax implications of each investment with the account type to maximize your return while minimizing taxes. So it's essential to consider your individual financial situation, investment goals, and tax bracket when implementing this strategy. And keep in mind, like I said, tax laws can change, so staying informed and working with a financial advisor can help you make the best decisions for your financial future. But if you're not having asset location conversations with your advisor, well, that's something that you may want to really think about if you are in the right place and working with the right person, okay? Tax loss trading and capital gain harvesting. So tax loss trading and capital gain harvesting are two strategies used by investors to manage their taxes and improve their overall investment performance. So let's break them down. Tax loss trading, also known as tax loss harvesting, is a strategy that involves selling investments that have lost value to offset gains from other investments. When you sell an investment at a loss, you can use that loss to reduce your taxable income from capital gains or even ordinary income. So for example, if you have a stock that has lost $1,000 in value, you can sell it and use that $1,000 loss to offset $1,000 in capital gains from other investments. If your losses exceed your gains, you can use up to $3,000 of the remaining losses to offset your ordinary income and any leftover losses that can be carried forward to future tax years. Okay? So tax loss trading helps you make the best of a bad situation by turning your losses into a tool to reduce your overall tax burden. However, be cautious of what's called the wash sale rule. So this prevents you from claiming a loss if you buy the same or substantially identical investment within 30 days before or after the sale. So very, very important to be aware of, okay? All right, capital gain harvesting. So this strategy is the opposite of tax loss trading. It involves intentionally selling investments that have gained value to take advantage of lower tax rates or no tax liability in a given year. For example, if you are in a low tax bracket and expect to be in a higher tax bracket in the future, you might sell some of your appreciated investments to lock in a lower tax rate on the capital gain. So for example, if you are a single filer and your income's gonna be below $40,000 or about $45,000, or a joint filer below about $88,000 or $89,000, well then you might be able to lock in a 0% capital gains rate. So capital gain harvesting can be useful in certain situations as well, like when you have unused deductions or tax credits that would otherwise go to waste, or when you expect significant changes in your future tax situation. So it's essential to carefully plan and consider the long-term consequences of this strategy. As selling investments, anytime you sell an investment, it can have other implications. So that can affect your overall asset allocation, you can incur transaction costs, and obviously you can incur additional taxes. So these are all things you want to think about. All right, but both tax loss trading and capital gain harvesting can be effective ways to manage your taxes and enhance your investment performance. However, they should be used thoughtfully as part of a broader financial plan, as it's always a good idea to consult with your financial advisor or tax professional before implementing any of these strategies. So distribution planning and Roth conversions are essential components of income planning for retirement. This is a conversation. A lot of advisors, they don't believe that there's a lot of value sometimes in Roth conversions because of whatever reason. I personally do. So if you're somebody who thinks taxes are going to go up in the future, then Roth conversions are something you should definitely consider, especially early in retirement, prior to taking all your income sources. Like for example, if you have not taken your Social Securities yet or your pensions and you have left your job, super good time to be thinking about Roth conversions. Okay, so Roth conversions will help you manage your income sources, or I should say, and distribution planning, will help you manage your income sources, taxes, and withdrawal strategies to ensure that you have a stable income during your retirement while minimizing your tax burden. So let's take a look at these concepts in detail. So distribution planning involves creating a plan for how you will withdraw money from your various retirement accounts like 401ks, IRAs, or taxable accounts to cover your living expenses during retirement. So generally, you're going to have 3 buckets of accounts, maybe 401ks or IRAs, which are pre-tax accounts, and you might have some Roth IRAs, and you might have taxable accounts or your bank account just with some cash in it. So, the goal is to find the most tax-efficient way to withdraw your funds while considering factors like required minimum distributions. So required minimum distributions are the distributions that have to come out of your pre-tax accounts now at age 73, and it will be at age 75 if you're born in 1960 or later. You also want to consider things like the tax brackets and your impact on Social Security benefits. So this stuff, again, can get very technical, but this is the conversations why I believe you should really get an advisor if you're somebody who has a large pre-tax retirement account. So a common distribution planning technique is to withdraw first from taxable accounts, followed by tax-deferred accounts like traditional IRAs and 401ks, finally from tax-free accounts. However, the optimal strategy can vary depending on your personal financial situation and tax considerations. Here's a situation I had just this last year, by the way. So I have a client that's a single filer as far as taxes go. And she has been taking distributions from her traditional IRA account just to fund her lifestyle. Well, we were looking at her tax planning at the end of the year around September, and it looked like she was about $4,000 close to going into what's called the IRMA Medicare penalty tax bracket. So it's $97,000 for a single filer. So if she continued to take her pre-tax IRA withdrawal, she was going to go above $97,000 of MAGI, which is modified adjusted gross income. So that would have cost her an additional about $800 to $900 in penalties for the next 2 years. So just by moving her distribution from pre-tax IRA to Roth IRA for the last couple of months of the year, we saved her $900 just by doing that alone. So let's talk about Roth conversions. Roth conversions are a strategy that involve converting some or all of your tax-deferred accounts, like traditional IRAs or 401ks, into a Roth IRA. Generally, you don't want to do the whole account in 1 year, okay? But when you do a Roth conversion, you're going to pay taxes on the amount converted at your current income tax rate. However, once the funds are in the Roth IRA, they grow tax-free, and you won't owe taxes on qualified withdrawals in retirement. Another benefit is there's no requirement of distributions on Roth IRA. So this can be a very powerful strategy if you're not 73 yet and you have not started taking required distributions, to really think about to get yourself some money from your pre-tax accounts to your Roth IRAs to give you another bucket to pull from in case you have a situation like I had just mentioned then. So Roth conversions can be a powerful income planning tool for retirement because they allow you to manage your future tax burden by paying taxes at potentially lower rates today. Additionally, Roth IRAs do not have RMD requirements, which gives you more flexibility in managing your retirement and tax situation. I love flexibility. So if you like flexibility, maybe Roth conversions are for you. So to effectively use distribution planning and Roth conversions in your income planning for retirement, consider the following steps. Number one is assess your situation, including the various retirement account balances, tax rates, projected expenses during retirement. If you're somebody who has very low expenses, then distribution planning and Roth conversions could be a huge benefit for you. And our case study is going to touch on that today. But really, really important. Also estimate your retirement income sources like Social Security, pensions, and investment income. Then you want to develop a withdrawal strategy that balances your income needs, tax implications, and the longevity of your retirement assets. And then four, determine if Roth conversions make sense for you and your tax situation, both now and in the future. So it is essential to review your income strategy periodically. I recommend annually, to make adjustments as needed based on changes in tax laws, your financial situation, or your retirement goals. But the reality is, the way I look at things too is tax planning happens all year. We might have RMD planning. If the market's down like it was last year, 20%. I was doing Roth conversions for clients in this year, like last month and the month before in February, March, and April, because the market's been down quite a bit, more than it has been over the last few years. And so this is a great way that if you can do a Roth conversion while the market's down, and then the market comes back, and you have all that money in a tax-free account like a Roth IRA, that's all going to be tax-free gain. So let's just do an easy example. I did a Roth conversion for a client while one of their accounts was down 20%. Their tax rate was 22%. So when we converted over, I'll just make up a number here, $10,000 from pre-tax to Roth IRA, and that money then comes back. They did pay the 22% on that, so that'd be $2,200. But when it comes back in the Roth IRA, they're going to get a tax-free gain. And if the market comes back to even this year, which it looks like it's on the right track, then they're going to make up their tax dollars that way. So very, very powerful. So working with a financial advisor or tax professional can help you ensure that your income planning strategy for retirement is optimized for your unique circumstances. So if I were you and you're looking for help with this from an advisor, you want to ask questions like, do you do retirement income planning? Tell me about your philosophy when it comes to distribution planning and Roth conversions. Do you take into account all my full financial situation? Help me plan for taxes each year, including what account I should pull from, what order, and how I should orchestrate my whole financial picture. If you're not getting that type of help and someone's just only doing investments and they're saying, don't worry about it, you're okay, you're fine, and they're not sitting down with you and helping you understand how to integrate your whole plan, again, these are things that, again, it's your money at the end of the day. I'm just trying to help you do the best thing you can do for yourself. And like I said, I had a comment last week from somebody who said their financial advisor was very upset with them because they started asking questions like I recommended that they ask. But I believe that we need to do more for clients than just simply do investments as certified financial planners, especially, and as a true fiduciary. We need to look at the whole picture, okay? So if you're not getting that, again, it's okay to shop around. There's a lot of good advisors out there. All right, so let's talk about charitable giving. So charitable giving can be a very rewarding part of your retirement plan, and it allows you to support causes you care about while potentially receiving tax benefits. So this could be a win-win. So one of the strategies to incorporate charitable giving into your retirement plan is through qualified charitable distributions, also known as QCDs. So let's explore how QCDs work and their benefits. So a QCD is a direct transfer, this is very important, a direct transfer of funds from your IRA to a qualified charity. Very, very important terms. Direct transfer, qualified charity. The distribution must be made from a traditional IRA or inherited IRA, and you must be at least 70 and a half years old in order to be eligible for a QCD. You can contribute up to $100,000, which is indexed starting in 2024 per year in QCDs, which can satisfy your required minimum distribution for the year, if applicable. So this is important. So the benefits here of QCDs for charitable giving in retirement include tax advantages. So the amount you donate through a QCD is excluded from your taxable income. This can be particularly beneficial for individuals who don't itemize deductions on their tax return, which is about 90% of people now, as they can still benefit from the tax savings associated with charitable giving. So RMD satisfaction is another way to use QCDs. So if you're required to take RMDs from your IRA, using QCDs can help you satisfy that requirement while simultaneously supporting your favorite charities. This can be a very attractive option for retirees who don't need the additional income from their RMDs living and for the living expenses. So for those of you that live in a very low, simple, frugal lifestyle, this could be a good way to keep your taxes lower and help out charities. Lowering your adjusted gross income, also known as your AGI. So since QCDs are not included in your taxable income, they can help lower your AGI. A lower AGI can potentially reduce your exposure to taxes and your taxes on your Social Security benefits, Medicare premiums, and other income-related taxes. So very powerful strategy if you're somebody who has a large pre-tax account and maybe you didn't do as much tax planning as you wanted to early. You're now 70 and a half. You got a couple more years until RMDs kick in, and you're trying to figure out a way to keep your taxes lower and maybe help out and do some good in the world as well. QCDs are wonderful for that. So to make a QCD, you should contact your IRA custodian and provide them with the necessary information about the charity you wish to support. They will help you facilitate the direct transfer of funds from your IRA to the charity. Incorporating charitable giving into your retirement plan through strategies like qualified charitable distributions can offer tax benefits and help you support the causes you care about. But it's essential to consult with an advisor of some sort, tax or financial, to ensure using the most tax-efficient methods for your specific situation, complying with all the necessary rules and regulations. So again, this can be a very powerful strategy for you, but just make sure you're doing it right. Simple. Let's talk about some tax gotchas, okay? A lot of tax gotchas, unfortunately, but it is what it is. So we're gonna talk through these here. So Medicare IRMA. So IRMA stands for Income Related Monthly Adjustment Amount, and these are surcharges that are additional charges that some higher income individuals must pay for their Medicare Part B and Part D premiums. These surcharges are based on your income and intended to ensure that higher income beneficiaries contribute more towards the cost of their Medicare coverage. So if you're not sure how Medicare works, Part B covers outpatient services like doctor visits, lab tests, and medical supplies. Most people pay a standard premium for Part B, but if your income exceeds a certain threshold, then you're going to be subject to the IRMA surcharges. Part D provides prescription drug coverage through private insurance plans. So like Part B, most people pay a standard monthly premium for Part D, but like I said before, if you have higher income, it's the same income level for both, you may have to face a IRMA surcharge. All right, so let's talk about how these surcharges work here. The income thresholds for IRMA surcharges are based on your modified adjusted gross income, okay? Important. It's not your AGI, it's your MAGI from the 2 years prior. So for example, if your IRMA surcharge in 2023 would be based on your MAGI from 2021. The income brackets and surcharges are adjusted each year for inflation. So keep in mind though, you can file a form. If you just retired, for example, and maybe prior to retirement, your income was above these Medicare limits I'm going to show you. If you go into retirement, if you get a notice that you're going to be impacted by this, then you want to go ahead and file a form to do that. And if you Google that, I believe it's SSA 44, don't quote me on that, but I think that's what it is. But if you just Google it, it will come up and you'll be able to find that, okay? So what are the income levels? So here are the income levels. That if you are a single filer and your income is below $97,000, no charges, and below $194,000 for joint filers, no charges. But once you go above that, Then for single filers between 97 and 123, you're going to pay an additional $65.90 for Part B, an additional $12.20. So it works about to $800 to $900 per year. And this is monthly, by the way, these charges. And similar here, you go through these income levels. One thing I want to talk about in a second is called the widow penalty. And what can happen is many people are below these numbers while they're filing joint taxes and married together. But later in retirement, if somebody were to pass away early, one of the spouses, and you have a big RMD or big pensions, it becomes very easy to go over these amounts. And not only are you going to have to pay additional taxes because you're in now the single filer tax rates, well, you're additionally going to have to pay potentially IRMA surcharges, which can be just another, it's kind of just like another jab in the side. It really is what it is. So it's unfortunate, but it's just what it is. But these can be planned for, and that's why we're here today talking about this. So it's essential to be aware of the potential impact of IRMA surcharges on your retirement planning, as they can significantly increase your healthcare costs. This could be $4,000 or $5,000 a year potentially. So strategies like Roth conversions, QCDs, managing withdrawals from tax-deferred accounts can all help you manage your income strategies and potentially reduce your exposure to IRMA surcharges. However, it's a good idea, and you can see I mention this over and over. It's always a good idea to consult with your advisor or tax professional to help you work a plan or create a plan that's going to work for you. Now, always admit, I'm a planner, I'm a certified financial planner. I see these things. I see when you put together a good strategy for clients, it could be tens of thousands of dollars or hundreds of thousands of dollars. I've even seen millions of dollars on somebody who only had a couple $1,000,000 in their retirement accounts between having a good, properly designed tax planning strategy. All right, let's talk about NIT, net investment income tax. So the net investment income tax is an additional tax that applies to certain higher income individuals, estates, and trusts. It was introduced in 2013 as part of the ACA to help fund Medicare and other healthcare programs. And it's a 3.8% tax on the lesser of your net investment income or the amount by which your MAGI exceeds specific income thresholds. Okay, here's a breakdown how it works. If your income is above $200,000 as single or head of household, or $250 married filing joint, or $125 married filing separately, then you could be potentially facing an additional 3.8% on the income above that. So this includes various types of income, such as interest, dividends, capital gains, rental and royalty income, and income from passive business activities. It does not include wages, Social Security benefits, or distributions from qualified retirement plans like 401ks and IRAs. But the calculation to determine it, the amount that you owe, well, you'll first calculate your net investment income and the amounts by which your MAGI exceeds the income threshold for your filing status. Then you'll pay the 3.8% tax on the lesser of these two amounts. Okay. Way too technical to dive into a calculation here. I'm trying to move forward, but I want you to understand how this works. So here's an example. If you're single with an MAGI of $220,000 and have $30,000 in net investment income, your NIT would be 3.8% of the lesser amount of $20,000, which is the amount by which your MAGI exceeds a $200,000 threshold, and not the full $30,000 of the net investment income. In this case, it'd be $760. So to minimize the impact of this, it's essential to manage your investment income and MAGI carefully. So tax-efficient investing, tax loss harvesting, managing the timing of your investment income can help reduce the exposure. And as always, good idea to speak to an advisor. Okay, this one here. So the widow's penalty refers to the potential increase in federal income tax liability that a surviving spouse may face after the death of their partner. This increase in taxes can occur due to a combination of factors, including a change in filing status, the loss of certain deductions and exemptions, and changes in income sources. So here's like the main reasons why the widow penalty can occur. Generally, a change in filing status. So when a spouse passes away, the surviving spouse's tax filing status changes from married filing joint to single or head of household in the following year. So the tax brackets for single filers are generally narrower than for those of married couples filing jointly, which can result in a higher tax rate on the same income. So for example, if a couple's combined income is $90,000 or $100,000 and they file jointly, after the standard deduction, they'll fall in the 12% bracket. But if you have $100,000 and you're filing in the single filer tax bracket, you're going to jump to the 22% bracket. So that's 10% more in taxes on the amount of money above the threshold, which is about $45,000 or so. And the other thing is you might lose deductions and exemptions. So when a spouse passes away, the surviving spouse loses their ability to claim personal exemptions and may experience a reduction in the standard deduction or itemized deductions they can claim. So your standard deduction might go from $27,000 down to $13,500. That's a huge deal when it comes to how much income you can qualify for in your 0% tax bracket or pay no tax on. So this can result in an increase in taxable income, which may lead to higher tax liability. And so the changes also in income sources could be a potential thing you want to think about too. So the surviving spouse may experience changes in income sources, such as receiving Social Security survivor benefits or income from life insurance proceeds or annuities. So some of these income sources may be subject to income tax, which could contribute to a higher tax liability. All right, to minimize the impact of the widow penalty, it's crucial for both spouses to engage in proactive tax planning. Some strategies to consider include diversifying your income sources in retirement, such as a combination of taxable, tax-deferred, and tax-free accounts, converting traditional IRAs to Roth IRAs during lower income years, which can help reduce future minimum distributions and manage income, reviewing life insurance policies and annuity contracts to ensure they provide appropriate coverage and income replacement for their surviving spouse. And, I recommend that, to me, it's essential to work with a financial planner or tax professional to develop a comprehensive plan that addresses the potential widow's penalty and ensures the financial well-being of both spouses. Okay, I think that's really, really important personally. All right, so coming up towards the end of this part of the workshop here, but here are 10 key questions to review with your taxes and or your tax advisor, and then we're going to jump to our case study, I believe. All right, so the first thing you want to do every year, review AGI, review your taxable income, review your marginal tax rate, and total taxes paid. How much room is left in the current ordinary income tax bracket, and what is the next closest bracket? So same for capital gains brackets. We're going to do an example of this. I'll show you exactly what this is. And look for any planning opportunities or pitfalls connected to your MAGI or Medicare IRMA surcharge. Then see, are you taking the standard deduction or itemizing and any related approaches around both? Any substantial carry forward losses that we can use to offset gains? Any substantial income or deduction swings from one year to the next, and anything we do about it going forward? Any tax inefficiencies that we should be addressing. So a big one is looking at what your capital gains and your either qualified or non-qualified dividends might be. Because if you have very tax efficient mutual funds, for example, or tax efficient like bond funds, those are things that if you just move those and you switch out, rebalance your account, then maybe going forward, it's going to be better for you to have some tax efficient funds outside of retirement accounts versus what you're doing currently. So, all right, number 8 is reviewing Roth conversion opportunities or other retirement planning opportunities. And are there any accounts we don't have listed on I call it our asset map report. If you joined on the last workshop, you saw what an asset map report is. You can also call it your financial inventory or your balance sheet. And you really want to look and see, hey, did you miss anything on your balance sheet that you're getting charged for from a tax perspective? And then any key ideas from the observations report not already covered previously. So ideally that you want to always double check and make sure that you are checking for all things. And then I'm going to go over an observations report that we put together for our clients to show you an example of that. So if you remember from last time, we had our case study for Jill and Bob. Okay, so what we've done here is put together a tax report for Jill and Bob that shows all of their whole tax situation in a very simple format. So this is all information. You can just gather it off your tax return, but this is something we put together for our clients. So if you want me to do something like this for you, just reach out and we can talk about that. And for Bob and Jill here, they have some very interesting things here that we want to consider. So let's talk a little bit about that. So the first thing we'll do is we're going to look at their key figures. Okay, so the total income for the year for Bob and Jill was $135,960. They got the standard deduction, or I should say this is what we're planning, okay? So this is a tax planning report for 2023. Their taxable income this year is expected to be $108,260 with a total tax paid of $14,432. Their filing status is married filing jointly, and then they're in the marginal rate of 22%, but their average rate or effective rate is only 10.6. So sometimes, we think that, if we're in a 22% marginal rate, then that means we pay 22% on all of our taxes. That's not the case. You're going to take your total taxes paid here, and you're going to divide that by your total income, and that's going to give you your effective tax rate. So technically, 10% of all the money they earn that year, 10.6, is going to the federal government. Let's talk about a little bit of the difference here between marginal tax brackets and capital gains tax brackets and how the system works. So you all know you get a standard deduction, okay? So in this case, it's $27,000 because we're filing as joint filers. Then we have two parallel tax bracket situations here in the US. We have marginal tax rates, and we have also our capital gains tax rates, okay? So the capital gains rates are pretty simple. It goes 0, 15, 20. So if you're filing jointly, if your income is lower than $89,250 and you have capital gains income, you're gonna pay $0, so 0% marginal rate on that. These folks, their income, their taxable income is $108,260. So they're in the 15% capital gains tax bracket, all right? So that's pretty simple. Then we have our marginal tax brackets. And our tax system here in the US is a progressive tax system, which means it starts lower for lower income and then it goes up as your income goes higher. So the standard deduction is what you can also call the 0% tax bracket. Then we have the 10% tax bracket. So that's going to be the next $22,000 they earn. And then the 12% bracket, which is going to be from $22,000 of income up to $89,450. And then from there, we have the 22% bracket, which is from $89,450 to $190,750 and so forth. So being at $108,260 of taxable income, these folks are, right above the 22. So this is where it gets a little bit interesting. So when I start to think about tax planning for these folks, and Jill is still working, okay? So Jill has a few more years. So when I start to think about Jill working, well, I start to think about, well, does she have a 401k? Because if Jill has a 401k, well, now we could potentially get her down to the 12% bracket for this year. But what's our goal, right? So if our goal is to reduce taxes in this year, then maybe we want to defer this year. If our goal is to reduce taxes over the long term, well, maybe we want to pay tax today and put the money somewhere else. So these are some things we need to think about. But since Jill is age 50 or older, she can put up to $30,000 in her tax-deferred 401k at work. So if we were to put the full 30 inside of her retirement account, she'd definitely be down in the 12% bracket after that, okay? So something to think about. Bob is retired. So, we don't really have a lot of options with Bob, but with Jill, we do have that retirement account available. But we're gonna focus on reducing taxes now, okay? So that's what's gonna be our focus. So if we were to put the full contribution into our pre-tax account like a 401k at work, then Jill's taxable income would be $78,260. So she would be under this $89,000 mark, right? So this could be very, very good. So again, something to think about. Another option we could do is if we just wanted to contribute just enough for Jill and Bob to get into the 12% bracket, then we could contribute $18,810. So if we took $18,810 into a pre-tax account, that would put us right to the top of the 12%. So they would pay no more than 12% on their income. And then what we could do is we could put up to $15,000, which would be $7,500 each, into two Roth IRAs. Because if you look here, Jill and Bob are under the adjusted gross income tier to contribute to Roth IRAs. So now we could do two Roth IRAs with that money, and we would pay no more than 12% tax on our Roth IRA contribution. Very, very, potentially very powerful over time. So if we did that, took care of this tax savings, we're going to save $1,500 in taxes today. We're also going to contribute to two Roth IRAs and keep them in a 12% bracket for 2023. So that could be one way that we go. Another thing we could possibly do is if we can get Jill and Bob, because here's a little trick, okay? The 12% bracket starts here, $89,450, but the capital gains bracket is $89,250. So I don't know why they do this stuff, but it just keeps me employed. But if we can get Jill and Bob below the capital gains tax bracket, and maybe want to sell off some stock, and we have some other taxable income or from a long-term capital gain, well, now we could potentially do that tax-free. So this could be a very, very powerful way for us to sell some old stock we want to get rid of and get that done tax-free so we can use her retirement account for that. Then what we could do is if we had some old stock we want to get rid of, maybe we can sell that and we can put that into a bucket that we use now for current retirement income. Or, just save it for later, and invest that money outside of her retirement account, start to build up the taxable account. So all very, very powerful stuff. In this case, if they could contribute all the full amounts to the retirement account, reduce their taxable income down to $78,260, and fully fund their Roth IRA, then they might save $1,678.50 potentially, on taxes. That could be a really good way to do it. So the other thing here, when we prepare a tax report for clients, is we're going to have some observations. And we're also going to give you some state-based observations. Okay. So in Missouri, 529 plans are deductible up to $8,000 for single filers and $16,000 for married couples. So if Bob and Jill wanted to contribute to a 529 account for their grandchildren or their children, for example, and they did the full amount of $16,000, that's another $848 in taxes that we're saving. So these are all things that, again, depending how you want to plan your retirement, depending how you want to plan your income, there's a lot of different things you can do when it comes to planning for retirement on the long term. So in this case, so far, we have saved potentially $3,178 for federal taxes and potentially $2,862 for state taxes between all of these income tax deductions. So, that's a pretty big chunk of money to put away for retirement. One thing I want you to take away is that as well, that Bob is 62, okay? So he has one more year before he has to worry about IRMA, because IRMA starts 2 years, as far as your calculations are concerned, 2 years prior to age 65. So this might be a good year for us to actually not put too much money in pre-tax accounts and actually pay the tax this year, because once Bob goes into his 65 and older time frame, he might have to pay a penalty if we do a big Roth conversion. So again, all things to think about here, and hopefully you're finding this useful and insightful. So this is an example of a retirement income plan that we may put together for a client. And so many people have no idea what they can spend for a client. So this tool helps us really set up something that can be super calming and beneficial and help you understand what you can safely spend in retirement. So let's talk about that a little bit. So as a reminder, Bob and Jill only need $5,833 for the retirement income. Well, based on their plan and their financial situation, it looks like they could spend closer to $9,000, and that'd be $7,352 after taxes, but they just need $70,000, as a whole. So for them, I can see now that they're now overfunded for their retirement plan. So what do you think that I'm going to be thinking about? Roth conversions, right? Or distribution planning, distributing some money early, or looking at Roth conversions in retirement. The other thing we're going to do for a client like Bob and Jill is help them set up an income adjustment plan. So what does this mean? So our philosophy when it comes to retirement is guardrails. Okay, so what that means is we're going to start with a safe spending amount, and if you spend that amount of money, you're going to be in a very good position. If your accounts go up, so in this case, they're expected to have about 1.1 million by retirement, and if their accounts reach $1,160,000, then we're going to increase their retirement income by about $453. That would be a 5% increase in portfolio. If their portfolio drops by 25%, then we're going to lower their monthly spending by $453. So this is a very, very powerful way to manage your income in retirement, and honestly, like low stress, right? Because you're going to know what you can spend safely. And as long as you spend below the amount that we're setting for you, you're going to be on track for the long term. Everyone that I've ever seen only does straight line calculations, okay? And what that means is you're using this tool and it's going to estimate Social Security increases are going to be, 3% forever. Inflation is going to be 3% forever. And then they just give you a Monte Carlo, right? They don't actually give you a safe spending number. They just say, okay, you're 80% chance you're going to be okay, or 100% chance you're going to be okay. And that's definitely an okay way to do it. But with the tool that we have here, we use is the actual economic data. And then we're going to take the actual economic data, and this is entered in monthly. We're going to run your plan every single month in the background, and we're going to make any updates we need to make and let you know what you can spend. But we have economic data back here, as you can see, to about March 1871. And what you're going to see here is we're going to use economically similar times to what we're dealing with today. So for example, economically, and this means, interest rates, inflation, things like that, we're very similar to a time like during the crash of the Wall Street in 1929. Also, after World War II. So a lot of financial planning tools don't take this into account. When you're doing a financial plan, we want to be more accurate when it comes to retirement than just simply saying, hey, inflation is going to be 3% forever. What have we learned in these last few years? Inflation is not 3% forever. Inflation can vary widely over time. So what we're doing for you in the background is running this plan every single month, and then we're going to update it as needed. And then, like I said, we're going to go back here and we're going to do our income adjustment plan as necessary over time. And the goal will be is that you never have to make a large adjustment in your income, and you stay on track and you can sleep at night knowing that we're watching this for you in the background, every single day. Or every single month, I should say. When I'm looking at Jill and Bob here, I know they're overfunded. Okay. So now we want to think about taxes and tax planning. So let's go to our tax center. And all right. So here's what I prepared for Jill and Bob. In their particular situation, it looks like bracket management is going to be the smartest way to go versus just taking their accounts in the traditional taxable, tax-deferred, tax-free like we talked about earlier. So by following a bracket management strategy, our tool is estimating that over time, if Bob and Jill just generally drew from their accounts, they drew their taxable accounts first, then their tax-deferred, then their tax-free, their average effective federal tax rate over their retirement would be 14.1%. Okay. So again, not terribly high, but definitely high. But if they follow a bracket management strategy, we can get that down by 5.4%, down to 8.7% average. What does this mean for you at the end of the day? This means we can reduce taxes by nearly $500,000. Okay. So this is what I'm talking about when I say having an advisor that is tax focused, that can help you with a distribution and Roth conversion strategy and an income strategy, how powerful this could possibly be. Not only that, is that we can increase the net legacy, so the expected amount of assets you're going to be passing on, by $281,274. So this could be a very, very big deal. And, it's just, again, it's super powerful, but just most people never really think about how they actually are going to do this and what this might actually look like for them over time. So we're going to start with what it could look like if these folks do nothing in the future, okay? And let's go forward in their retirement to, because Jill's only about in her late 50s, I believe. So let's say Jill's now in her 80s. And if Jill does nothing in the future, she's going to have an RMD of about $159,000. Her total income is going to be around $310,000. And so this is not going to be pretty because they only need $70,000 to live off of. So even if you do an inflation adjusted amount, it's not going to be anywhere near this. But if we do some bracket management, and what that's going to look like is doing some Roth conversions early. So once Jill retires, her first 4-year retirement will be in 2027, and we optimize the 22 or what's going to be the 25% tax bracket, we are going to do a relatively large Roth conversion of $128,639. But look what happens later in retirement. We don't have any RMDs. RMDs would be pink. We don't have any RMDs ever, right? We get this done early, okay? And so what that means is by not having any RMDs ever, by getting our taxes paid early, we're going to be in a low tax bracket throughout retirement. And like I said, the average overall effective tax rate is going to be about 8.7, and we're going to save over time nearly $500,000, and not just based on the current estimates of taxes. So we don't know exactly where that's going to be, but these are all things that we're going to do our best to manage for you and help you out with that. So this is the potential power of having a tax efficient retirement strategy in retirement that is, ideally going to give you the overall best picture for you and your financial situation. So if you're somebody who has a large pre-tax retirement account, if you're somebody who is concerned about taxes in retirement, then we're definitely would be happy to speak with you. But this is what I wanted to cover with you today. So now we're going to move to Q&A and see what questions you guys have here. If you're somebody who, like I said, has that big pre-tax retirement account, usually these strategies work best with people who are at least like $800,000 or $1 million or more. That's usually the best, but definitely can benefit these with smaller accounts. But if you're somebody who has a big pre-tax retirement account, you definitely want to think about everything we talked about today and speak with your advisor or reach out to us at keepitsimplefinancial.com. Okay, what's the difference between AGI and MAGI? So AGI is your adjusted gross income and MAGI is your modified adjusted gross income. So there are things like non-taxable interest, for example, from municipal bond funds that are part of your MAGI that don't count towards your AGI. So MAGI is just all income. and your AGI is just your adjusted gross income. So you'd see those two things generally on your tax report or on your tax return from your professional. So let me ask, if we gave $15,000 for a Roth, is this supposed to reduce our total income when we did our taxes? No, Michelle, really good question. So Roth contributions are after tax. If you're contributing to a Roth after tax, remember, like for Jill and Bob, we talked about putting that $15,000 in 2 Roth IRAs, $7,500 each. That's going to be after tax. So it's not going to reduce your total income when you do your taxes, but what it will do is give you tax-free growth so that in retirement you have another bucket to pull from that's going to be tax-free versus a 401k or traditional IRA where all of those funds are going to be taxable when you get those. So really good question though. Tammy asked, are all life insurance policies taxable? No, not necessarily, Tammy. If you have a life insurance policy and somebody else passes away and you're the beneficiary, that's going to be tax-free income. If you have like a cash value policy and you have cash value that you want to remove or you want to close that policy, then yes, the gain, anything you've gained on that is going to be taxable, generally your marginal tax rate. So really good question there as well. Okay, so Rick asked what my fee structure is for financial planning. So financial planning, Rick, is based on complexity, and it's a range based on the complexity of the situation. If we do a project together, it's generally somewhere between $4,000 to $6,000, and it can go up if you have more complex situations, and then we have ongoing type of offerings as well. So thank you for asking that. If you go to keepitsimplefinancial.com, go to fees and services, you'll see all of our fees here. So we have some different options here. We charge a 1% fee up to $1 million. And 0.8% above that, and then 0.5% above $5 million for asset management. Our financial planning fees, if you just want to pay a fee for advice, those start at $200 a month, and that would be an annual, so 24 annually and up from there. If you just want a keep it simple financial plan, like I said, starting at $3,000, with the average being between $4,000 to $6,000, and again, everything's there. So feel free to check out my site if you want to know more, but that's what it is. So that's what I have for you today, folks. I appreciate your questions and I appreciate you watching today. But what I want you to take away from today is really think about your retirement situation in advance when it comes to taxes. If you plan early, it could be so much more beneficial for you. You can have so much of a better experience and honestly save a lot of money. Like I showed you there, these folks, they had $1 million, okay? But we're looking at saving almost $500,000 in taxes with proper tax planning. So these are all things that, like, yeah, I showed you a fee there. You're going to pay something, but if we put a plan in place for you that makes you 5 or 10 times or even more than that than we're charging, then everybody wins. And then you don't have to do it yourself, by the way, because there's a lot of knowledge you need to have. So again, we're here for you. If you need help, go to keepitsimplefinancial.com if you want that assistance and schedule a call. We offer a free complimentary consultation. If you want to just do a tax report and get that information, reach out to me by email there. So go to my website and send me an email and I'll send you what that would cost. And if you want to have me review that with you, we can do that. And other than that, I really hope that you found this presentation useful, beneficial. I wanted this to be a really good, thorough presentation on what anybody needs to know about taxes and retirement. So we can always go back to this and say, okay, what do I need to know in a simple form? Like I said, you got the 6 key areas you need to know, the 10 questions to think about when it comes to working with your advisor or your tax planner. And if you have those things, then at least you're gonna have a game plan, you know where to start. And then from there, it's just digging into your individual situation. And that's the thing with retirement planning is you're individual. You have a different amount of money. You have a different spending needs. You have a different overall situation when it comes to Social Security and pensions. So this needs to be done on a unique individual level. And if, like I said, if you want our help, reach out. If not, at least find a fee-only certified financial planner to help you. One that focuses on tax planning will be your best bang for your buck. We will see you on the next one. Bye now.